So the market just took a massive nosedive. And pretty much everyone is asking the same question. Why? Was this just one single thing, or was it something a lot more complicated? Well, we're going to break down the three core drivers that came together to create this perfect storm of financial chaos. It really all started with this one number, negative 900. I mean, that's the staggering drop the Dow Jones took in its single worst day since June. Now, this wasn't just some minor dip, okay? This was a full-on dive that sent some serious shockwaves through the global markets. But here's the thing, a drop this steep is almost never about just one thing. So what was the real trigger? Was it the return of trade war fears? A government shutdown happening at the worst possible time? Or was the AI bubble, the one everyone's been talking about, finally starting to pop? Let's dig in and find out. Here's how we're going to tackle this. First, we'll look at the plunge itself. Then, we're going to dissect the three key drivers one by one: a geopolitical shockwave, a crazy data crisis, and that big AI bubble correction. And finally, we'll talk strategy. What do you actually do now? Okay, so let's start with the plunge itself. This wasn't just a random bad day for the market. No, this was a genuine perfect storm, where three incredibly powerful forces all slammed into the market at the exact same time. And boom, it unleashed this massive wave of uncertainty. And the impact was, well, pretty severe. I mean, beyond that 900-point drop in the Dow, the S&P 500 had its worst day in months. The whole mood on Wall Street just flipped to risk off, which is basically code for investors dumping anything that looks risky and just running for safety. And the sectors that got hit the hardest? Yep, technology and semiconductors. They found themselves right in the eye of the storm. So, what was the first major driver in this perfect storm? It was an external shock. The ghost of the US-China trade war. It came roaring back to life, and the market absolutely panicked. You see, the trigger was this renewed threat of major tariffs on Chinese goods. And we're not talking small stuff here. We're talking about everything from the electronics you use every day to the critical tech components that are basically the backbone of the global supply chain. For investors, this wasn't just a headline. It was a direct threat to corporate profits. And the impact was immediate. It was brutal. The semiconductor giants took a direct hit. AMD plummeted nearly 8%, and NVIDIA dropped over 4%. Now, why them specifically? Well, it's because they are so deeply reliant on China for both manufacturing their chips and for selling them. So tariffs hit them from both ends. Their costs go up, and their revenue is threatened. It's a double whammy. And this whole situation brings us to a really crucial concept called de-risking. Faced with all this uncertainty, American companies started feeling immense pressure to move their supply chains out of China. But here's the catch. That is an incredibly expensive and super slow process. Investors looked at that and thought, wow, the high costs of this are going to eat into company profits for years, which in the short term means lower returns for shareholders. Now, get this. While that whole external storm was brewing, a completely different crisis was unfolding right at home in Washington. And it was basically blinding the very people who need to see clearly to guide the economy. The U.S. federal government shut down for 10 days. Congress just couldn't agree on a budget, which meant for over a week, key government functions just stopped. And the effect that had on the market was profound. This created a state of what you could call data blindness. Think about it. In a normal market, investors and the Federal Reserve, they rely on the steady stream of official government data to make big decisions. Without that data, you're flying blind. You're forced to rely on private and often less reliable estimates. And that lack of a clear picture, well, it just breeds uncertainty and fear. So what kind of data are we talking about? What exactly went missing? Oh, just the big ones. The official inflation numbers, which are absolutely crucial for predicting what the Fed's going to do next with interest rates. The official jobs report, the non-farm payrolls, which is our best look at the health of the job market. With the Bureau of Labor Statistics closed, the market's most important navigation tools were just gone. So that brings us to our third driver. With all this fear and uncertainty swirling from the outside, the market finally turned its attention to a problem that had been building up for months: those dangerously high valuations in the AI sector. You see, for a lot of these AI stocks, the excitement had just gotten way ahead of reality. Their stock prices weren't based on what they were earning today, but on these super optimistic projections for years and years into the future. That's what people mean when they say future growth is priced in, and it creates a really fragile situation. When bad news hits, these are the first stocks to tumble. And this wasn't just some idle chatter either. We're talking top executives like JP Morgan's Jamie Dimon, who were publicly warning of a valuation bubble. Now, when leaders at that level start speaking out, institutional investors, they listen, and it often becomes a signal to start selling and take some of those profits off the table.
But what's really fascinating is that the sell-off wasn't random. A very clear differentiation started to emerge. On one side, you had the AI stocks that were driven by pure hype, with no clear path to actually making money. Those got dumped, and fast. But on the other side, you had what people started calling AI quality stocks. We're talking companies like Amazon and Microsoft, with super strong fundamentals and solid cloud infrastructure. Investors saw these as the real long-term winners.
So, after all that chaos, investors were left with one huge question. Was this the start of a recession, or was it a rare opportunity to buy quality stocks at a serious discount? This is where strategy really comes into play. The consensus among a lot of analysts was that this wasn't some deep fundamental crisis in the economy. Instead, they saw it as a necessary correction, a healthy, a little painful, but healthy process of shaking out all the excess speculation. It creates a more rational market. And guess what? A correction always creates opportunities. So what's the game plan then? Well, the strategy really breaks down into 3 pretty clear steps. First, look for those buy-the-dip opportunities in solid growth stocks that now look a lot cheaper. Second, focus on high-quality global companies that are now trading at more reasonable prices. And third, as always, diversify your portfolio with stocks, gold, alternative assets to manage that risk. The real takeaway here is this: a downturn like this can actually be a powerful screening tool. A crisis has a funny way of revealing which companies have weak foundations and which ones are built to last. The strongest ones, the ones with real profits and durable advantages, they're the ones that are ultimately going to rebound the fastest. Which leaves us with a final, really interesting question to think about. Was this market plunge the beginning of the end for the great AI boom? Or was it actually the best thing that could have happened? A painful for sure, but necessary filter that finally separates the fleeting hype from true, lasting quality. Definitely something to consider.